Gary DeWaal here, and this is Bridging the Week for September 1st to 5th, and today is September 8th, 2014. Good morning! No one theme permeated the major news developments last week in worldwide financial services. Banks received much attention in the United States with new proposed margin rules for uncleared swaps and final rules regarding liquidity and their leverage ratio. One court granted senior executives of MF Global unfettered access to the company's D&O insurance pool to help them in their defense of customer actions, while another court began considering a purported class action complaint involving allegations of an ISDAfix manipulation. And finally, there was a request for relief for certain investment funds to the CFTC and a conflict of interest case by the SEC involving an investment advisor. This past partial week back to work in the United States was tough for many of us, but let's get right to the major stories this week. Last week, the Federal Reserve Bank and 4 other federal agencies proposed margin rules for uncleared swaps entered into by swap entities they regulate, so-called covered swap entities. In general, the new proposed rules address when, in connection with uncleared swaps, covered entities must collect and post with their counterparties initial and variation margin, calculation methodologies, eligible collateral, and the protection of collateral. The proposed rules exempt non-financial end users from mandatory margin requirements, but authorize a covered entity to collect margin, nonetheless consistent with its overall credit risk management. The other agencies involved in this rulemaking are the Farm Credit Administration, the Federal Deposit Insurance Corporation, the Federal Housing Agency, and the Office of the Comptroller of the Currency. According to the 5 agencies, the new rule is warranted to better safeguard the financial system. Quote, during the financial crisis, the opacity of swap transactions among dealers and between dealers and their counterparties created uncertainty about whether market participants were significantly exposed to the risk of default by a swap counterparty. By imposing a regulatory margin requirement on non-cleared swaps, the Dodd-Frank Act reduces the uncertainty around the possible exposure arising from non-cleared swaps. End of quote. Obligations regarding variation margin are proposed to be effective December 1st, 2015, while requirements regarding initial margin would be phased in between 2015 and 2019. Comments are due in response to the proposed rules by 60 days after their publication in the Federal Register. 3 federal agencies, including the Federal Reserve Bank, approved a standardized minimum liquidity requirement for large and internationally active banking organizations. The goal of the requirement is to improve the resiliency of these significant banking organizations during times of financial and economic stress. In general, such organizations must maintain an amount of unencumbered, high-quality liquid assets that is no less than 100% of their projected total net cash outflows over a potential 30-day stress period. This requirement is generally consistent with the liquidity requirement instituted by the Basel Committee on Banking Supervision. The other 2 agencies participating in this rulemaking were the Office of the Comptroller of the Currency, Department of Treasury, and the Federal Deposit Insurance Corporation. The effective date of the rule is January 1st, 2015, with a phase-in of the requirements over 2 years. Separately, the same 3 federal agencies finalized a rule related to certain banking organizations' so-called supplemental leverage ratio in connection with the calculation of their risk-based capital requirements. This calculation endeavors, quote, more appropriately to capture a banking organization's on- and off-balance sheet exposures, end of quote. Beginning in 2015, such organizations must disclose this ratio, and starting in 2018, they must maintain a minimum supplemental leverage ratio capital requirement of 3%. Deutsche Bank agreed to pay a penalty of 4.7 million Great British pounds to the Financial Conduct Authority for failing to report to it accurately, as required, all of its contract for differences equity swaps from November 5th, 2007 through April 19, 2013. FCA alleges that during this time, Deutsche Bank failed to report correctly over 29 million relevant swaps in that it reported buy transactions as sales and sales transactions as buys. SCA claims Deutsche Bank's failure was particularly serious, quote-unquote, because it had consistently advised firms of the importance of accurate transaction reporting, during the relevant period publicized numerous breaches by other firms of their reporting obligations, and issued a private warning to Deutsche Bank on June 3, 2010 regarding its reporting failures. CFDs are tradable instruments that mirror the activity of the referenced asset without their holders actually owning the asset. Check out my compliance weeds on this matter on the article version of Bridging the Week on the website. The Securities and Exchange Commission filed an administrative complaint against an investment advisory firm and its co-owners for their failure to disclose to their customers a material conflict of interest. The respondents are alleged from 2005 through to December 2011 to have recommended that their clients invest in particular mutual funds at a broker-dealer without disclosing in any manner that they receive payment from the broker-dealer offering the funds. The SEC also claims that beginning in December 2011 through 2013, the respondents made some disclosures, but they were not adequate. During the relevant time, the firm received almost $450,000 in payments from the broker as a result of the sale of the particular mutual funds. The respondents are the Robert Group, Ltd., Mark Robert, the firm's founder and an 83% owner, and Jack Jones, a 70% owner. 14 former MF Global executives are entitled to access most of a $200 million Directors and Officers Liability Insurance Policy purchased by MF Global Holdings prior to the firm's filing for bankruptcy in October 2011, under a decision of a U.S. bankruptcy court in New York City last week. Previously, the executives had made a motion to access the insurance. However, the bankruptcy plan administrator, customer representatives involved in civil litigations against MF Global entities, and the Securities Investor Protection Act trustee all opposed the motion. In ruling this way, the court nonetheless noted its concern regarding, quote, the rate at which proceeds of the D&O policies are being spent. More than US $48 million in defense costs and expenses have been incurred so far, and not a single deposition has been taken in various customer proceedings, end of quote. However, the court acknowledged that it had no authority over the executive's rate of spending of the D&O proceeds. And finally, 14 financial institutions were sued by Alaska Electrical Pension Fund for their roles in alleged manipulating the ISDAfix benchmark rate from January 1, 2006 through January 2014. As a result, claims the pension fund, the named financial institutions, quote, conspired to avoid paying the true amount owed when investors' ISDAfix-linked investments were in the money by jointly manipulating the ISDAfix rates used to determine the amounts due to investors, end of quote. ISDAfix is a global benchmark for interest rate swap transactions. This case is a purported class action litigation. Well, that's it for this week's Bridging the Week. As always, there is more information in each article and more articles on the article version of Bridging the Week on the website. Check it out. Until next week, this is Gary DeWaal, and have a great week. Ciao!